For more on this commodity dollar story, let's bring in Chip Hanlon. He's president of Delta Global Advisors. He's with us from Washington this morning. Chip, you say the upward movement in commodities is strictly a dollar story. We hear from the likes of Jim Rogers that commodities are all about supply and demand. Is that to say that, in your opinion, the commodity prices cannot continue rallying unless the dollar keeps going down?
Yeah, that is my opinion in the short term. I mean, Jim Rogers has been very right, of course, on this commodities play. He was amongst the very first a decade ago to talk about the long-term demand side story for the world's raw materials coming from a rising Asia. But in recent months, I don't think you can square the price of, say, oil with anything but a fall in the price of the dollar. I mean, from a supply and demand standpoint, Saudi Arabia and other important OPEC producers have cut production twice. The world's land-based storage facilities are filled to the brim. We have half a day's global supply and sitting in idle tanker ships around the world. So you can't say that it's a supply and demand situation that's driven the price of oil higher this year. It really has moved lockstep in opposition to the dollar, which has been incredibly weak.
Chip, how low can the dollar go? How high can gold go?
Well, it's going to depend on our policy choices in Washington. What the world is deciding is that it's starting to really question what will be the future value of its dollar holdings if we keep interest rates at nothing, essentially, and if we keep following fiscal policies where we're borrowing so aggressively from the future. Will we really be able to pay those debts back in dollars that are worth as much as the ones today? I think the world's deciding that that is unlikely. It's a very precarious time for the United States. We've put ourselves in a really terrible position, and we're actually making policy choices which are going to make the problems worse long term, and the world is recognizing it.
Chip, how do you square your outlook with what we see in the Treasury market? For a long time, we saw Treasury prices rallying as people flew, let's say, to safety, and the dollar went up during the crisis. Now we've got the dollar going down, but Treasury prices are rallying again. How does that play into the commodity picture?
You're right. The Treasury market, Eric, that's a great point, that it is the one piece of the global market picture that is not screaming inflation. I think there are a couple of reasons for it. First, you have to remember that last quarter, about half of all of our Treasury issuance was purchased by the Federal Reserve. We're buying our own debt. That's the definition of monetizing the debt, to keep interest rates low. But there's also another factor at work there, and there is an element of the stock market or the global markets that doesn't really trust this rally, that thinks it's going to be short-term, sort of inflation-led, but that our policies aren't going to lead to lasting growth, and that we're going to live through a W type of situation where we're going to have another scary downdraft, perhaps on the backs of a commercial mortgage crisis. Regardless of what it is, there are still those who are holding on to Treasuries, figuring they might still be a flight to safety in one more downturn should it occur.
Do you think we could hit 2.5% to 3% by year's end for the 10-year on yield?
That'll depend. To get that low, I think we would need another equity markets disruption like we saw last year. I mean, I think we'd need a pretty vicious sell-off. And that, trying to guess when that might occur, or if, is difficult, because we are really trying to inflate. And I like to say that if Washington blows on the straw hard enough, it can create bubbles. It's creating one in the stock market right now as well, unfortunately.
Talk to us then. I just want to get your quote here, Chip, for gold. You kind of avoided the question. What's the price per ounce that you think we're going to hit, and by when?
Oh, I'm sorry. I wasn't trying to duck it, Deirdre. I think there are a couple of ways to look at it. One is, in the short term, you have to like the technical action of the U.S. dollar. If you look at what it did early in 2008, early last year, it spent about 6 months or so creating a broad top in that $850 to $1,000 region. And this year, it spent about 6 months or so, about a similar amount of time, eating through that overhead supply, which it has now broken through. It suggests that there should be very little chart resistance for gold at this point. And you might expect, on a short-term basis, the length of this next rise to look a lot like the length of the decline last year. Last year, gold fell $300 or so per ounce.
$1,400 an ounce, $1,500 an ounce? What are we talking about?
I think you could get $1,400, $1,500 an ounce gold in pretty short order, perhaps by next year, barring a dramatic global stock market sell-off.
All right, Chip, we thank you so much for your time.